Okay, we're on video 7 now, and I thought this was going to be a short chapter. Silly me. Okay, a few things I'll just point out. Down here they talk about if a contingency can only be estimated within a range, then the minimum amount should be accrued. That is, again, if it is both probable and the amount can be reasonably estimated within a range. All right. And they talk about loss contingency is disclosed in the notes to the financial statements if there is at least a reasonable possibility that the loss will occur. And product warranties, I talked about those earlier. They commonly give rise to contingent liabilities. And so we need to estimate those and record those and then explain how you went about it in the notes. The method used for determining product liability estimates is the expected cash flow approach. And we've looked at that before, where we estimate the amounts and the probabilities, multiply, and then add. And that gives us the amount we record. Now, sometimes companies have enough experience that they don't have to go through these various amounts and the probabilities. They may have enough experience to just say, we think experience shows us it'll be 3% of sales or something like that. There's the journal entry: debit warranty expense, credit warranty liability. Now, extended warranties, new revenue recognition approach that you learned actually made extended warranties a lot simpler. Prior to that change in revenue recognition, very commonly when extended warranties were sold, companies would recognize the revenue for the sale of the extended warranty as current revenue, and then they would have to estimate the liability and record a contingent liability for the estimated costs, warranty costs. Now, the new revenue recognition principle changed the way revenue was recognized on extended warranties. And now, for extended warranties, revenue is recognized over time, over the life of the extended warranty, and the expenses are recorded as incurred. So, anyway, it just makes it a lot simpler. Usually the warranty revenue is recognized over the life of the warranty on a straight line basis, and then any warranty service costs are recorded as incurred. All right, that takes care of that. Net income in the year of the extended warranty will, in each year of the extended warranty, will reflect both the warranty revenue recognized and the costs associated with that revenue. Okay. Here they get into rebates and coupons. Rebates are, again, taken care of in the revenue recognition principle, and they are a reduction of revenue. So they are not contingent liabilities. Coupons are contingent liabilities, and you may need to look at them to consider them. Quite often, coupons are not viewed as material, and therefore you don't have to worry about recording a contingent liability. Okay, litigation claims. In theory, litigation claims should be handled exactly as any other contingency. You should look at whether the outcome, loss from the outcome is probable, reasonably possible, or remote, and then record the liability accordingly. Now, as they point out here in your book, in practice, that pretty much never happens. Few reasons for that, but the biggest reason is right down here. If you recorded a liability in a lawsuit, the opposing counsel would welcome that as ammunition in the courtroom. They would stand up and say, look at their financial statements. They know they're guilty. They know they should have to pay. They recorded a liability here. No lawyer wants to see that happen. So if you ask the attorney, and it doesn't matter how clear-cut it is that they're going to be liable, you ask the attorney, what's the probability you're going to lose this case? I guarantee you what they're going to say. They're going to say, we're going to win this case. I feel confident. Reality is they never want to in any way say anything that could be interpreted as we deserve to lose. So right here they make the point, companies sometimes accrue estimated legal costs, including lawyer fees, but they never record contingent liability as a result of a lawsuit. Now, if they have a whole range of lawsuits, they may just accrue a cost and say that is our recording of estimated legal costs, including any potential judgments. But they're never going to break it out by lawsuit or anything else for that matter. So, the book spends a ways talking about that, but that's the gist of it. Now they get to subsequent events. Generally speaking, in accounting, subsequent events do not have an effect on the balance sheet, except to the extent they make known something that existed at year end but was at that point unknown. Now, contingent liabilities can be the same thing. Let's say at year end you have a pending lawsuit, and let's say that it gets settled in January before you issue financial statements. Well, in that case, it makes known a condition that existed at year end. At year end, you were liable. You were going to have to pay. You just didn't know how much, and you didn't know for sure you would. So it gets settled in January, then you need to go back in December and record that contingent liability. It makes known the amount. You take advantage of that. All it's doing is making known something that existed at year end but was unknown at that time. So now, other subsequent events, let's say you have a building and you have it recorded on your books for $10 million and it burns down in January. Are you required to show that building as not existing on your balance sheet at December 31? The answer is no. You show the building on your balance sheet at December 31, because that's what existed at the time. Now, it's not a case where the building was destroyed and you just didn't know it. It got destroyed later. You do have to disclose the impact of subsequent events in the notes to the financial statements. But the only way subsequent events affect the financial statements themselves directly is if they make known something that actually existed at year end but was unknown at that point. Okay, so right here they talk about used to clarify the nature of financial statement elements. That's discussed, not disgusted, discussed all in here. Okay, right here, if information becomes available that sheds light on a claim that existed when the fiscal year ended, that information should be used in determining the probability of a loss contingency materializing in estimating the amount of the loss. All right, so we have several homework problems. Let's see how far we can get with 12, 13, 14, 15, and 16. So 12, Wright Medical introduced a new implant that carries a 5-year warranty against manufacturer's defects based on industry experience with similar product introductions. Warranty costs are estimated to be approximately 1% of sales. Sales were, excuse me, I had to cough. Sales were $15 million. The actual warranty expenditures were $20,000 for the first year of selling the product. What amount, if any, should Wright report as a liability at the end of the year? Well, the answer is they should record as an warranty expense 1% of $15 million. That would be $150,000. Now, so they would debit warranty expense for $150,000, credit warranty liability. Then as they paid these $20,000 in claims, they would debit warranty liability and credit cash. So what's left in the warranty liability account? $130,000. So we see that right here. There are the warranty expenses, debit warranty expense, credit warranty liability. We actually pay those. We debit warranty liability, credit cash. So we're leaving a balance of $130,000. Okay, let's go to the next one. Consultants notify management of Goo Goo Baby products that a crib toy poses a potential health hazard. Counsel indicated that a product recall is probable and is estimated to cost the company $5.5 million. How will this affect the company's income statement and balance sheet this period? Well, a product recall is probable. So the contingency is probable and the amount can be reasonably estimated. You record an expense or a loss and a liability. So how's it going to affect the income statement, the balance sheet? The income statement is going to reflect a $5.5 million loss or expense. The balance sheet is going to show a $5.5 million liability. So $5.5 million loss in the income statement, $5.5 million liability in the balance sheet. Okay, next one. Skill Hardware is the plaintiff in a $16 million lawsuit filed against the supplier. The litigation is in final appeal, and legal counsel advises that it is virtually certain that Skill will win the lawsuit and be awarded $12 million. How should Skill account for this event? Well, I didn't talk about gain contingencies yet. I'm not sure if I just skipped over that or if it hasn't come up in the book yet. But gain contingencies are real easy, and that is you don't record them. So they would not record anything for that gain contingency. So they should disclose it, but it's not recorded. We do not accrue it. Okay, our time's about up. I will pick up with brief exercise 315 on the next video.